A key milestone this quarter was securing a $650 million convertible bond, a significant achievement for our company. While Gary will provide further details later, it's important to highlight that our path to reach 50 exahash by the first half of 2025 is fully funded, without relying on equity to fund that growth. Our first quarter revenue was $162.3 million, representing a 120% growth compared to the same period last year. We closed the quarter with net income of $246.8 million, or 85 cents per basic share, while our adjusted EBITDA, a key measure of operational efficiency and financial strength, grew to $321.6 million, setting a new benchmark for the industry. While Bitcoin's price appreciation during the quarter was a contributing factor to our strong performance, it was not the sole driver. Our success is the result of our best-in-class Bitcoin mining operations, disciplined capital strategy, and long-term view of Bitcoin as a strategic asset. Unlike others who sell-mine Bitcoin immediately, our strategy of holding self-mined Bitcoin on our balance sheet, coupled with world-class operational execution, continues to be a key differentiator in delivering these exceptional results. During the quarter, the average price of Bitcoin exceeded $83,000, reaching a peak above $108,000, where our marginal cost per coin was approximately $34,000. This is a $2,000 improvement from the prior quarter. Meanwhile, our total Bitcoin in treasury stood at 9,952 at the end of the quarter and reached 10,556 as of the end of last month, demonstrating our ability to outpace the increasing global hash rate and mining difficulty. Our fleet efficiency stood at 17.59 joules per terahash at quarter's end and has since improved to 16.15 joules per terahash as of January 31st, making our fleet one of the most efficient in the world, a metric we expect to continue improving in the coming weeks. Our strategic presence in energy-abundant states strengthens our ability to scale efficiently. By all measures, this was an exceptional quarter, one that sets the stage for our next major milestone, 50 exahash. The foundation for this growth was laid in January of last year, when we secured 60,000 S21 units with a strategic option to acquire an additional 100,000 units at the same low price. This commitment gave us a significant competitive advantage in scaling efficiently over the past year. Building on that success, we expanded our investment in efficiency 6 months later with another order for 26,000 S21 XP immersion units, the most efficient model to date, again securing an option for an additional 50,000 units. This structure enables us to deploy new highly efficient machines in alignment with our energization capacity, ensuring immediate productivity and eliminating idle assets. Our option contract also provides the flexibility to scale beyond 60 exahash at a cost of $21.50 per terahash, which is significantly below the spot market, where prices are currently more than 37% higher. The infrastructure required to achieve the additional 10 exahash necessary for our mid-year target is already sourced, including transformers, power distribution, low-voltage components, and additional immersion cooling infrastructure, like those successfully deployed in Cheyenne, Wyoming, and Jackson, Tennessee. Construction is already underway in Tennessee, Wyoming, and Georgia, and we will provide updates as additional megawatts and exahash come online. While M&A is not required to reach 50 exahash, we remain disciplined in evaluating strategic opportunities. In a bull market, acquisitions often come at a premium and can be capital destructive. However, we continue to assess opportunities selectively, particularly those involving companies with strong power contracts but lower efficiency fleets. Other targets may include small-scale sites where owners face capital constraints in upgrading their fleets. As some operators pivot from mining to high-performance computing, we may see opportunities to acquire Bitcoin mining-specific assets at attractive valuations. Expanding on that theme, I want to address another model that introduces similar counterparty risk, partnering with the artificial intelligence and broader high-performance computing sector. While some of our industry have pursued a speculative approach to HPC, repurposing a Bitcoin mining facility for high-performance computing is far more complex than it may appear. And now I want to take a few moments to address the significant shift in sentiment we are seeing in Washington, D.C. regarding Bitcoin. Over the past 4 years, we've built our business in the face of meaningful regulatory headwinds. Since the November election, that environment has begun to shift. President Trump has expressed consistent support for our industry, reinforcing his commitment through key policy positions and regulatory appointments. One of the most pivotal developments came on January 24th, when the Securities and Exchange Commission repealed SAB 121, an accounting rule that discouraged banks from offering digital asset custody services. This repeal marks a major turning point for Bitcoin regulation. In addition, we are encouraged by strong legislative leadership in Congress. Two of the most vocal advocates for our industry, Senator Lummis of Wyoming and Senator Hagerty of Tennessee, have been appointed to the Senate Financial Services Subcommittee on Digital Assets. Their deep understanding of our industry will be invaluable as lawmakers work to establish a more balanced, responsible regulatory framework for Bitcoin and digital assets. We will continue to monitor these developments closely and remain engaged with policymakers to ensure that our industry has a seat at the table as these regulatory and energy policy decisions unfold.
Thank you, Zach. As Zach mentioned, our first fiscal quarter was spectacular for CleanSpark. Let's dive directly into the numbers, which I'm excited to share with you. Our revenues for the quarter were $162.3 million, an increase of $88.5 million, or 120% over the same quarter last year. This increase was primarily driven by an overall increase in average Bitcoin price. Of importance, year over year, we produced only 4% less Bitcoin compared to the same quarter last year, despite block rewards being cut in half this past May. We are almost at the same number of Bitcoin produced as pre-halving due to our increasing exahash and increased fleet efficiency from our best-in-class miners. It is also important to note that our average revenue recognized per Bitcoin produced in Q1 was almost $84,000, which is an increase of 130% over the same quarter last year. When compared to the immediately preceding fourth quarter, our revenues increased 82% due to the increase in Bitcoin prices and our Bitcoin production. For comparison, we produced 480 or 33% more Bitcoin in the first quarter than the fourth quarter, and the average revenue per Bitcoin at our wholly owned sites increased 38% between the periods. CleanSpark has industry-leading uptimes typically in excess of 98%. However, this past quarter, we saw a slight temporary decrease in our uptime to 94%. This was driven by several factors. Foremost, the quarter started with limited exahash online because of a hurricane. Second, we moved approximately 80,000 miners as a result of our fleet upgrades and racking at new locations. However, I want to point out that while we saw a slight dip in one of 5 key industry metrics, there's an inverse relationship as we saw significant gains in efficiency and Bitcoin produced, as well as reduced cost per coin. This upgrade resulted in significant ROI as our fleet efficiency dropped from 21.94 joules per terahash to 17.59 joules per terahash, or 20% between Q4 and Q1 alone. And as I mentioned earlier, our Bitcoin production rose 33% between periods. Looking at our margins, our gross profit increased by $47.1 million year over year, with a profit margin of 57% for this quarter. When compared to the immediately preceding fourth quarter, our gross margins increased $59.9 million, or 186% during the periods. While you have heard us mention several times that our fleet efficiency continues to increase, the power of scale is demonstrated here through our margins. For example, our cost to mine a Bitcoin was $36,250 in the fourth quarter. However, in the first quarter, we saw that cost per Bitcoin decrease to approximately $34,000, which represents a quarter-over-quarter favorable improvement of about 6%. Our strategy to maintain one of the most efficient fleets in the world, combined with best-in-class uptime and operations, is translating to significant margins, and all while the global difficulty has increased during the same time frame. This quarter, we recognized net income of $246.8 million, which is a significant improvement from prior periods. This increase was primarily driven by the growth in the fair value of our Bitcoin and a gain related to Bitcoin returns as a result of our paydown of the Coinbase line of credit. This theme continued with $321.6 million of adjusted EBITDA for the quarter. While our cost of power per kilowatt hour in this quarter is running higher than in prior periods, our margins are far exceeding this increase, thanks to the efficiency of our fleet and on-site operations. Additionally, with Bitcoin mining economics better than prior periods, we have more headroom and capability. This allows us to run our fleet through periods where the cost per kilowatt hour is elevated. With respect to our indirect costs, in the first quarter, our total professional fees, payroll, and G&A expenses totaled approximately $34.8 million. This is a decrease of $5.8 million, or 14% compared to the preceding fourth quarter. This decrease was attributed to lower professional fees of approximately $1.8 million, primarily due to the transactional fees we had in Q4 related to M&A activities. Payroll expenses decreased 16%, or $3.9 million quarter to quarter due to year-end bonuses recognized in the fourth quarter. Lastly, our G&A expenses saw a slight decline of about 1%. While professional fees may fluctuate with activity related to M&A and financing transactions, I'd expect indirect expenses otherwise to be relatively flat or increase only a nominal amount for the remainder of the fiscal year. We believe our balance sheet is one of the best in the business. We have almost $2.8 billion of total assets, almost half of which is liquid in the form of cash and Bitcoin. As you are aware, we issued a $650 million convertible note transaction, which we closed on December 17th. The industry's only 0% coupon, 100% up with stock buyback. With the net proceeds, we purchased a cap call, which made the effective conversion premium 100%, or $24.66 a share, and we bought back approximately 11.8 million shares of our stock. The stock purchase is reflected as treasury stock, and our total outstanding shares have decreased as a result. Additionally, we used $50 million of the proceeds to pay off the line of credit with Coinbase, and that capacity remains available for us to use at our discretion. We're proud to have closed this offering, which more than fully funds our growth through 50 exahash and beyond. In addition to funding the growth to 50 exahash, share buyback and cap call, the remaining proceeds will allow us to keep adding the Bitcoin we mine to our balance sheet for the near term. Beyond our expansion efforts already underway, we remain well positioned to continue executing on opportunistic acquisitions. Importantly, this offering provides our stockholders with greater clarity on near-term share count, given our ATM offering was completed in early November, and we have no immediate plans to commence another equity or ATM offering, as the capital received from the convertible notes sufficiently covers our near-term strategic objectives. As of the close of the quarter, we had over $1.2 billion of liquidity, which includes approximately $276.6 million cash and almost 10,000 Bitcoin. You may have heard us speak about our conservative approach to debt on our prior calls. I expect that we will continue to be cautious in further leveraging our balance sheet, as we will evaluate our balance sheet health on a net debt basis to ensure we have proper liquidity to operate the business and service near-term debt at all times. We continue to have discussions regarding non-dilutive or less dilutive options, which is reflective of the maturity of our capital strategy as we build out our capital stack and utilize our very profitable operations and clean balance sheet for accretive growth opportunities. Turning to our Bitcoin treasury, it's important to note that it represents the fourth largest position amongst public corporations in the world, trailing only a handful of competitors and larger than the holdings of major corporations such as Tesla, Coinbase, and Block. In contrast to many of our peers, our Bitcoin HODL was mined exclusively in the U.S. by Cleanspark at a significant discount to the spot market price on the back of our best-in-class operations. Our net debt approach to the balance sheet gives us far more flexibility when it comes to cash management and funding future growth. As impressive as our Bitcoin stack may be, we want to put it to work productively to help fund the business. We are actively building an institutional-grade Bitcoin treasury team and strategy with the goal of preserving capital, opportunistically managing cash, and driving a lower cost of growth capital in non-dilutive ways. Because of Bitcoin's unique place as an emerging global financial asset, we can adopt best practices in treasury management from traditional finance while harvesting volatility for our benefit. We are currently engaged with high-quality counterparties to evaluate a holistic approach in utilizing our treasury to meet business needs, and we expect to go live shortly while ramping up activity over the ensuing quarters.
Mike Colonnese with H.C. Wainwright, please go ahead.
Gary, you alluded to some of this on your prepared remarks, but just curious if you could provide a bit more color here. So you guys have built out a nice reserve of Bitcoin over the past year, now have over 10,000 Bitcoin on the balance sheet. Any further details you can share in terms of what your Bitcoin treasury management team is strategizing to put those coins to work, be it the counterparties, current market yields you're seeing, and what portion of the treasury you'd be willing to dedicate to yield generation strategies?
I don't want to commit to a strategy. In fact, I'll refer you to what we said last call, where it's going to be a crawl, walk, run type strategy. And ultimately, we have a number of options available at our fingertips. So we'll see how those RFPs come back and really what the transaction opportunities look like. But ultimately, I don't think in the near future we're going to leverage, 100% of the HODL balance or, put 100% of it to work. We're just going to slowly kind of leak into it. And we'll have more to report on in future quarters.
Bill Papastasiou with KBW, please go ahead.
For my question, we're just hoping you could add some color on how you're weighing the growth strategy beyond 50 exahash. The quarter clearly demonstrated an attractive operating profile. And where you guys stand today at 40 exahash, you're not very far from being the leader in the space in terms of scale. So how important is it in the road ahead to scale, just given that all your peers are moving to AI HPC? Seems like it could be a low-hanging fruit opportunity for investors that are looking for a high beta play on Bitcoin.
We love when we hear someone pivoting to HPC because it means global difficulty goes down. And so as we continue to scale in that environment, it just means the piece of the pie that we're getting of daily Bitcoin rewards, which again are scarcer every 4 years. So now is the best time to acquire it. It means our piece of the pie gets bigger. So yes, continuing to scale is important, but it's not an end-all be-all, right? Again, we don't grow to grow. We grow because it's strategic to do so, and it means that we have more to gain. Again, at the point we're at, every exahash we add is dropping Bitcoin or dollars to the bottom line. And so as long as that continues to prove, we will continue to grow responsibly in the ways we do.